Hi, welcome to the Halftime Report. I'm Scott Wapner. We'll keep our eyes on that hearing today before the House Financial Services Committee down in Washington, bring you any more headlines that you need to know about. There have been several to this point that are rather significant. Perhaps the reason why the stock market is near the highs of the day, extending those record highs on the S&P and the NASDAQ. But Dow's good for about 160 as well. You could make the case that the Fed chair really stayed the course to what he said yesterday before Senate banking, setting the table, if you will, for a rate cut over the next couple of months. He did say today not going to wait until 2% to cut rates. Job not done, but inflation is moving substantially and sustainably down to target, but also mentioned the labor market once again, which he says has cooled rather significantly. I've got the investment committee with me here: Joe Terranova, Shannon Saccocia, Brian Belsky, Farmer Jim Lebenthal. I mean, that's what we're talking about today. He continues to make the case. He talks about the two-sided risks, but he continues to underscore that the labor market has cooled, and he knows they're on the clock, that they need to do something before the labor market gets out of hand.
Absolutely. And he's focused on the labor market. They have a dual mandate. It's inflation and labor. He told you already he doesn't need 2% on inflation for the Federal Reserve to cut rates. He's focused on what's going on in the labor market. He told you it's cooling significantly. The rate cut is coming in September. The market is pricing it in, and you're actually getting a little bit of the broadening out today.
Brian Belsky, you've got your 5,600 target. We're above that level for the first time ever.
Yep, welcome to the year-end. Welcome.
But you say you're sticking with it. Why are you sticking with it?
You know, we are. 7 months ago, when we came out and talked about this market, we said that in the second year of a bull market, you typically see a 9.4% correction. We've only had a 5.5% correction. And we still think there's way too many bulls out there, and we think there's a very good chance we get a pullback. Now, our bull case is for 6,000. We really think that we get a better buying opportunity to add to stocks, and then we'll have a very strong recovery from that to the tune of 15 to 20%, which is on average.
Why shouldn't you be bullish, given what the Fed chair is telling you?
The market's got it right today. I mean, this is amazing. Yeah.
Well,
so
just today?
No. Well, let's talk about today. I think the market has gotten it right in terms of the path of interest rates. Now, it just means that I just think that the momentum is too centered on buying right now. We're going to get a little overbought on a technical basis. From a fundamental perspective, we still believe that we're in a 25-year secular bull market, Scott. This is the second year of the cyclical bull part of it, and we're going to get a pullback.
More worried than you've been in years is what you told us the other day. Give us, a read into your psyche and what you're thinking about this market today. As we said, we're extending the record highs. S&P 500 above 5,600 for the first time ever. Technology's leading. NASDAQ's good for, 0.75% today as rates are down and kind of everything's up. The financials are the only sector that's in the red.
Yeah, well, I'm going to field the question you gave to Brian just a second ago of, why wouldn't the markets be bullish? Is because the string of rather poor economic reports that we've had for several weeks now. I won't go through a long list, but we've seen initial weekly jobless claims and continuing claims pop up. We saw ISM services go below 50. I don't want to go through a long list, but here's the good news. If Joe is right, and I think he is, by the way, that what Chairman Powell is saying is that we'll get a rate cut in September, we can make it through. It's going to be a bumpy ride, and it actually critically depends on the earnings reports coming up, not just being good for the second quarter, because who cares? We already know that was good. What it critically depends on is the guidance going forward. That starts tomorrow, Scott. You know that. Mr. Bastian, the CEO of Delta, here's a guy who is generally quite optimistic. The last thing in the world that you want to see is him saying something negative about demand going forward for air travel. I mean, that would make it difficult to bridge the 2 months from here until that first rate cut. And I know there's some people who are saying, what does 25 basis points really matter? It's a clear sign that they're going to continue to lower
it matters as much as it mattered on the way up.
Exactly.
It's the beginning.
Exactly.
Of
if you don't fight the Fed on the way up, then you applaud them on the way down.
Shan, 6,000, the highest target we have on the street from Evercore ISI. Has the market got this right?
I think they may. I think that the challenge, they may. With a higher probability than 50%.
Okay. Why the hesitation?
Well, I think the path to get there is critically important. So what haven't we talked about today? What haven't we talked about? The bond market. What haven't we talked about? Expectations of potentially higher fiscal spending to thwart the efforts of the Fed to bring inflation down. Those are concerns that we start to see crop up perhaps in that August, September, October timeframe. When you start to think about what derailed us last year, Scott, was it fundamentals in the stock market? No, it was concerns about the bond market. It was
there were
concerns
concerns about the bond market. Now their rates would be moving up. In fact, they're not. That story's known.
They're not right now. So I think the challenge here goes back to Jim's comment. We are looking at an environment where everything that the Fed is looking at and everything that many economists are looking at are in the rearview mirror. So does the macro matter right now to keep this rally going? Probably not as much as it did if we get that rate cut in September, because then the macro picture is known. More about the guidance of the second half of the year. Where are we seeing slowing? But more importantly, where are we going to see growth? Are we going to finally see reshoring? Are we going to see industrial capex? Are we going to see the financials come out and talk about a rebirth in capital market activity? Because there's going to have to be something where you see earnings growth slow incrementally in big tech. Earnings growth is expected to pick up for outside of big tech, but you need to see that in the next 3 or 4 quarters to keep the dream alive.